All right. Good evening, everyone. This is Daniel from Tradecraft 360, and I thought I would detail a trade that I placed on Friday, December 6th, 2024, and that was on AppLovin. And I am familiar with this name, as many traders are, and it's had a monster run since it released earnings, and I would know as I put a trade on before earnings, and it was a gap and go. And I can also sort of detail what happened to me on that particular trade. So lessons were certainly learned there. But let's first and foremost clarify what I did on Friday. So because I do follow this ticker, and I've just been seeing the relentless momentum and elevated put premium and call premium, it's always tempting to make trades on this. And I elected for an ultra short term type of trade. So this was on December 6th, about 2 hours before market close. And AppLovin was trading for 414, 415 at the time, I believe. And I elected to sell a near money or at the money put. And just because of the elevated premiums, especially going 2 hours into the close. And that was sold for $14.40. And I will detail that right here. So orders, executions. Oh, it's taking its sweet time here. All right, so there it is. You can see the position there. So the reason it is sort of grayed out is that this is something that has expired, and that's why it's detailed that way. So this is the 30 contracts here that you see sold for $14.40, and the time is over there. I sort of detail that in the analysis section so you can take a look. And yeah, it looks like I sold it with only about an hour and 10 minutes left to the close. So in any event, that's why you put on the position. Number one, familiarity with the name, having traded it before. And relentless momentum to the upside. Now, obviously, the risk of reversal is high, especially a bit at this stage of the game, just because of the massive move in AppLovin. Not to say that it won't break out to new all-time highs. It certainly can, and I probably would expect that, but you could expect some two-way action as well. So in this case, I had my eye on this for the entire remainder of the RTH session and into the after hours. So into the close, it did decline and closed at around 400, and then as you can see here, I shorted 3,000 shares in the after hours, and I got filled at 402.84.12. And it's kind of an interesting way of playing AppLovin or any type of ticker, especially into the close over a weekend, is that because of the elevated put premium, I was effectively giving myself a level of protection. 410 minus 1440 is my adjusted cost basis, so that's 395.60, and that is the point in which I would start to lose money on this position. And fortunately, it did close above. And instead of waiting for Monday, and I would obviously be subject to market risk on Monday's open, I elected to short 3,000 shares in the after hours to neutralize the trade. So on Monday, I will be assigned the 3,000 shares that will end up in the account. And because I'm short 3,000 shares, poof, it's gone. It's closed out. And the resulting profit was 21,000 US. So not bad for an hour's worth of work, if I do say so myself. However, it carried with it interesting risks. So some of those risks were as follows. What if in the after hours it got above 410? All right. Now, your broker will auto exercise you on any option that closes in the money, calls or puts. However, unless you instruct them not to. So technically, and each broker is a little different, your counterparty can elect not to exercise their option or elect to exercise their option, depending on what happens in the after hours. That's why a lot of traders like to close things out, not take the after hours risk. In this case, I elected to do so, and I was monitoring things. And in this particular case, it got as high as 408, 409, and then reversed, and then actually continued to reverse to 380, 385. I think it actually got as low as 375, and then climbed from there. So certainly there was risk. It could have gotten above 410, and then if it had gotten substantially above 410, then my counterparty could have elected to or declined to exercise the 410 put, and then on Monday I'd be effectively short 3,000 shares, not be assigned the 30 contracts that I sold, and on Monday I'd be subject to whatever the market's doing, whatever AppLovin's doing, and that could have been a little bit painful, but to me it was a risk worth taking, and it did actually work out in my favor. AppLovin did decline as I thought it could. I was just thinking, this does look a little toppy. I did want to take advantage of the put premium. It was excessive for the hour left in trading. And I am somewhat familiar with this name. I do feel comfortable if I were to be assigned, or had I not been able to short, or, let's just say, for instance, that AppLovin went from 410 to 390. Would I have been comfortable with the loss? No, I wouldn't have been. I probably would have just bought a put, sold a call, and just elected to trade it, all right, and see what happens from there. So in this particular case, it actually worked out quite in my favor. My adjusted cost basis of $395.60, closed it out for $402.84.12, and made $21,000, and that's the opportunity that I saw, that I elected to take advantage of, and I am glad I actually decided to curb my risk when I did. I didn't want to see what would have happened later on. I got in early. I could have closed it out maybe at 406, 407, 408. That certainly would have been better. But it did dump to the 377, 380s, and then climbed up to 385. So sometimes I like to just neutralize things earlier, not take the risk. And in this case, that turned out to be I think what amounts to a correct decision. And it's also quite interesting as a trader just to work through the different scenarios. Okay, well, what happens in the after hours? What happens if you don't get assigned? What happens when you do get assigned? What happens on Monday? What type of risks are you taking? So on and so forth. So lots of interesting things to think through in your own head, and analyze and work through these different scenarios and what you're going to do as a trader based on the price action, and how you're going to defend positions or how you're going to exit positions. And I gave you my example of what I elected to do, and it turned out in my favor. Obviously, the position size is quite large. 30 contracts, that's 1.2 million. So not inconsequential in that sense. So yeah, looking forward to seeing what happens on Monday. So I thought I'd detail sort of what happened to me earlier. So I happen to own, let's see if I can find that position here. Yeah, there it is. Let's go to options. There it is. All right, so this turns out to be my biggest mistake of the year, and you're more than welcome to take a look, so I'm not bluffing. I bought the January 17th, 2025 150 call for $14.60. Yes, that is correct. I bought 30 contracts. for $14.60. And that initial position is now worth 686,000 or thereabouts. Unfortunately, as I typically do, I sold a covered call or a calendar or a diagonal, whatever you want to call it. And why did I do that? Because I needed to cover this initial purchase cost of $14.60. It was my lack of familiarity with AppLovin. This was not a ticker that I knew too much about. To me, it was just another tradable security. So I didn't really appreciate the upward risk. So typically what I do is when I purchase a call and I sell a covered call, if there's a lot of momentum to the upside and I trust the underlying and I think that the market environment is appropriate, then I'll just double up on the position. That's usually what I'll do. I don't think too much about it. That's not quite true, but I tend to err on the side of caution, which is to say, if the security that is exhibiting appropriate price action to the upside, momentum in the context of a conducive market environment, and let's say the underlying is something you're familiar with, has a long track record, like Amazon or Apple, or the list goes on and on, things that have a lot of history behind it of outperformance, then I'll just buy in before it hits the upper strike. So, and that usually, because I use very short dated calls and I keep my position sizes under control, and I buy in earlier, sooner rather than later, then I actually make more money on that because I'm taking advantage of momentum, which is a real phenomenon in the markets. And certainly on shorter term time frames is when it's most useful. Certainly there are risks to that type of strategy, the risk of reversal. So you buy into Amazon and then in anticipation of being called away at a higher strike, and it reverses on you. Now you've just doubled your position size. However, I find that's not the biggest risk. Typically, those types of things can be managed. You can either sell it in the money call, you just wait for a reversal, you keep your position sizes under control. More often than not, because it takes a lot of momentum to get to these upper strikes, that's a sign that things are healthy, things are good, things are heading in the right direction, that things are doing what you think they should be doing. And so therefore it's actually a strategy. Momentum is a real thing. You just buy in and ride the wave higher. You can do that, and that's a separate trading strategy unto itself. You just buy in, and then it breaches your upward strike. You deliver the shares at the upward strike, or whatever call strike that you sold. Deliver those shares, and then you get called away, and then you still have the original position, for which you then reassess, reevaluate. Maybe you sell another set of calls, right? Sometimes you don't have to do that. It depends. Like if things have gotten so ridiculously overbought and way too far away from the 8-day moving average, then sometimes I'll just leave it, right? And then if there's a reversal, then obviously you got called away, those shares are short. It allows you to buy to cover and make even more money. So it all just depends on the ticker, the time frame, the market environment, et cetera, et cetera. Those are all things that you sort of weigh as a trader. In this particular case, I didn't really appreciate what was happening. To be honest with you, didn't really understand what AppLovin, how they made their money or what they did. I still don't. It's not something I looked into. I'm not a fundamentals guy. I'm a trader. So, I look at different types of setups. And when it breached my upward strike, my initial reaction was, well, likely there'll be a reversal and I'll be able to buy in lower. or I'll sell a covered put, or I'll sell an in the money put, or I'm not going to chase this higher. I didn't want to double up on my position. I didn't want to, uh, you know, have to go in and purchase another 30 contracts or another 3,000 shares or etc. It's just, it wasn't a ticker that I knew too much about or had a lot of trust in or a familiarity, and I elected to play it a little bit safe and not buy in. And that cost me dearly because it just went, it gapped, and it went. And there was no opportunity for me to cover that short. So that's where you see these 30 contracts. So this is what I did. I did get called away, and what strike? I think I got called away at around like 180 or 185. In any event, instead of just having their shares sit there short, I elected to just sell an in the money call, collect additional cash premium from the call, and then extra extrinsic value from the 160 call. And so I had already lost left money on the table of close to 400,000. And this is what you're seeing after that point forward. I left another $250,000 on the table. So instead of making 686,000, I think I made like 30 or 40,000. So that will go down as one of the heartbreaks of the year. Notwithstanding the 21,000 I made on Friday. And it happens, right? So, the lesson learned is when you see the momentum, you see the strength in the underlying, you see a breakout, try to be a little bit more definitive, a little bit more aggressive. Don't try to second guess yourself. If you think that this is a ticker that has some legs to it, then just go in and buy the extra 3,000 shares, and that would have been the correct move. So, in any event, thank you for paying attention. I appreciate it, and feel free to read about all of this in the analysis section as well. And feel free to leave any comments and take it from there. All right, everyone, have a great rest of your weekend, and hope that you have a great trading day tomorrow. Take care. Bye-bye.